Hi, good afternoon, everybody, and welcome to our first in a series of webinars with my co-host, Carolyn Roach. Carolyn, how are you?
I'm doing really well today, Ian. Thanks.
Great, great. Well, my name is, we'll just start with some background because why not? My name's Ian Thompson. I'm a real estate broker here at RE/MAX of Nanaimo. I've been a realtor 18 years, and I like to talk about real estate and educate folks about what's going on in the market. And I run a real estate team here, so we're certainly up to date with what's happening. And we're going to get into that a little bit. And first, Carolyn, tell us about who you are.
Yeah, so my name's Caroline Roach. I'm a mortgage broker here in Nanaimo. I've been licensed for 13 years. I'm a broker owner, so I have two business partners at Fitzwilliam Mortgage Corp. We're a mortgage center franchise. And like Ian, I like to talk about all things mortgages and help educate not just my clients, but anyone who's interested about the ins and outs of different mortgage products, different lenders, and how they can use it as a financial tool in their toolbox.
Excellent. So our goal is we're going to be doing these once a month. And with that, we will get started. So first, I thought we would start with, what's happening in the real estate market. I'm just going to share my screen here so you can see a few things I put together just to go over there. Everybody can see that now. Everybody shakes their head going, yes, yay. Okay, there we go. So here's the sales report for the city of Nanaimo. Now, I always do single family and then condominium and townhomes. And I went back 4 months because there's been a lot of talk about real estate in Canada, about when the peak of the market was. So in some markets, it was January, February. I think March was the high water mark for the city of Nanaimo as far as real estate activity goes. And so on the first one here, you're going to see single family in March, our average price was $970,000, and we sold 150 single family homes. Now, this is, of course, all over the city, all different price ranges. That was our average. And then you'll see to April, we start going down in May and June. So last month, our average was 883, which is about a 9% drop from the high watermark. And the number of homes sold about 20% down from the peak. Condominiums are interesting. We still see the prices $469, and now it's $485. It's actually higher, but the sales volume is down quite a bit from 37 to 29 condominiums sold in the month. We had a whole new condominium project sell up off McRobb, a brand new building, which actually they're pre-sales, and they're not going to be done until the end of 2024. But they were higher priced, so the sales that were happening were in that higher price range. That's what's reflected there. And as far as townhomes go, our average price in March was $621, now $550, and the number of sales down quite a bit from 34 to 12. In my opinion, this is the market where we're seeing a lot of price reductions are townhomes, patio homes, which is interesting. And I think it's because a lot of people that were going to buy those were going to sell larger homes in Nanaimo worth more money, and now they're not getting the same activity, which means they can't move forward and buy that next downsizing townhome. So we're seeing price reductions there. If you're a cash buyer in the townhome price range, you're going to be able to get some good deals. So when I mentioned cash buyer there, let's just stop there for a second. Caroline, when you're working with people, clearly they're coming in for a mortgage and they're seeing the changes, or are they actually aware of how big the changes have been?
I think the people who are really aware of how big the changes have been are the people who have their rate holds expiring right now. And so they locked in rates. And what I found interesting about, especially that single family residential, is showing that March to June. Well, we could put right beside it what the 5-year fixed interest rate was for March, April, May, and June. And as you saw that average price going down, those rates were going up. March is right when those rate hikes started. And that, we're seeing that correlation between fixed, January, February, you could still get a fixed rate, in some cases around 2% and definitely under 3%. March hit and then up it went. And so I think that's the real impact that we're having seen on the housing market there, are those higher rates. And so people's rate holds are expiring now, right? They locked into a great rate for 120 days back at the end of March. And now those are coming up and they're expiring, and we're having to requalify them at today's rates. And there's a change. There's a definite change, and your borrowing power has dropped.
some of the people I've been working with, I don't think appreciate the amount of change. And I guess that's the whole point of, one of the points of our doing this webinar today is to make sure people understand it's quite significant.
It is.
Probably the most significant in recent memory, certainly in my 18 years in the business. It's the speed of the change, the accelerated quickly. Usually this is over time, and it's the same with you, right?
Yeah. The only other time during my career that I can say we saw a significant drop in borrowing power over a short period of time was back in 2017 when the stress test was introduced. So that stress test was an initial 20% drop in buying power for everybody the day it was implemented. And that's the only other time I've seen something like this, where we're seeing, I can share my screen here.
Yeah.
Share my screen here.
Yeah.
I can.
You go ahead and do that.
So here there's some data. I used average annual income within my database over the last few years.
Okay.
Anchor point. So this is on an income of 90,000, but the percentage drops are going to be the same no matter what income bracket you're in terms of how much your borrowing power has dropped. So at the beginning of the year, so this orange one is January and this blue one is July. This is for uninsured mortgages and on a 5-year fixed. January, at a $90,000 annual income, you'd be looking at mortgage funds about $448,000. That number has now dropped down to $361,076. So that for the 5-year fixed, that's a significant drop. That's about a 20% drop in what you can qualify for. Now, this is on an uninsured mortgage, right? So this is for people who are purchasing with 20% down or more, or refinancing their mortgage. That anything that falls into that uninsured category, which also includes amortization of 30 years, anything greater than 25. On the insured, so these are people, particularly in most cases, first-time buyers and whatnot, who are purchasing with less than 20% down. So those 5%, 10% down purchases. And in that category, in January, you could qualify for about $412,000. Now, today, that number's dropped to $348,000. And that's about a 16% decrease in buying power for the 16% who are in that insured territory. Now, remember, that's on fixed rates. So variable impact is a little bit smaller. So in the uninsured realm back in January, with that average income of 90,000, you could qualify for $448,000. And note that's the same as what you qualify for on the fixed side. We could talk about that a little bit, but that number has now dropped. If you're going for a variable, at 80 in the uninsured territory, and that's about a 10% drop. So not quite as big of an impact for those who are comfortable with a variable. And on the insured side, so again, people purchasing with 5-10% down, anything less than 20% down, they've gone from $412,000 in January to $391,000 now in July, and that's about a 5% drop in their borrowing power. And
what percentage of Canadians are getting an insured mortgage?
You know what? That's a really good stat that I don't have off the top of my head. Okay. I'm just going to stop my share here. I'm going to make a note to look that up.
Okay.
I'm going to guess it's actually a lot lower than we think it is. Majority of my clients that I'm working with are in the uninsured territory.
Mm-hmm. So the people that are coming in to get a mortgage, what are typically the things that they're forgetting to, let me just back up. I can go online in theory, right? In theory, I listen to the ads and it says, hey, in 60 seconds, I'm qualified to borrow $600,000. And yet when we're working with people and they tell us that, right away, the alarm bells are going off because that's just not accurate.
That is not accurate. I mean, it's a great starting point. Let's put it that way. But if you're actually going out and house hunting and you want to be making offers, that is not something that you want to be relying on. The most important part of that pre-approval or pre-qualification process is document review. So if you're just plugging numbers into an app based on sort of, this is, I know what I make, this is what my debt payments are. Like I said, that's a starting point, but the way your income is calculated could vary. And so you might be plugging in a number for your income into that app that isn't actually accurate, isn't your actual qualifying income that we can use. And so that's where working with a broker who's going to vet all your documents up front and come up with that actual qualification number for your income, underwrite your file as if you're making an offer tomorrow so that you know with some accuracy what your budget is. Because little things like it could be that you've been working 30 hours a week, but you're actually only guaranteed 15. So, you go, oh, well, I'm working 30 hours a week, so I'm going to plug my income in at 30 hours a week. That's how much. Well, no, that's not your qualifying income. Because if your letter of employment says you're only guaranteed 15 hours a week, unless we have a 2-year average that you've been working consistently for 2 years at the 30 hours, as opposed to the 15-year guaranteed, we can't use that higher income. So little intricacies like that can really affect your borrowing power. That's why you have to work with someone who's going to vet all your documents up front.
Now, there's a lot of talk in Canada about self-employed. More of us, I'm self-employed, you're self-employed, a lot of us are. But that's a whole different realm of qualifying, isn't it? For people, it's great that you are self-employed. When you go to borrow, it's a little trickier.
And there's significant differences too between, some self-employed individuals are sole proprietors. And so they're just, they're claiming their taxes as a sole proprietor. They're filling in a statement of business and professional activities. How we treat that income is very different than how we treat income for someone who's self-employed and incorporated. So someone who's set up a corporation and owns that corporation and is running their income into that corporation before it comes out to them. Those are two very different ways of calculating income. And so those are all those little unique things that go into how we come up with that qualifying number.
So that no one should be out looking at real estate until they've talked to someone like you. There's really no point in doing that. We've had a couple of examples. It's very, it's very heartbreaking, I think is the right term to use when you think, I'm going to go buy a house, and then we find one and it's like, well, wait a minute. I feel like I'm in quicksand here because I don't have the answers to these questions, right?
Yeah, exactly. No, the number one thing you should do before you start house hunting is work with someone who's going to vet everything up front, underwrite your file, and show you what that looks like so that you know what your budget is, so you don't get that disappointment, because it is heartbreaking to find a house, fall in love with it, and then find out it's not in your budget.
Let's talk about the stress test. Let's talk about, that's great that this is today's interest rate, but that's not what you're qualifying at. Do you want to walk us through that?
Yeah. So I mentioned the stress test earlier. It was implemented in 2017. We've had some updates to it over the last couple of years. But essentially what it says is if you're qualifying for a mortgage here in Canada, you have to qualify at one of two rates. And it's the greater of them. Either 5.25%, which is currently the qualifying or benchmark rate set by the Bank of Canada, or your contract rate plus 2%. So back when rates were really, really low, everybody was qualifying for everything at 5.25. Because you think, back in 2021, we had interest 5-year fixed rates of, 1.64%. Well, 1.64 plus 2, that's 3.64. So we're qualifying you at that stress test rate. And it's funny, when the stress test first came into place, it was a big, the sky is falling in the mortgage industry. It was, and then everybody's adjusted.
Our industry too. Yeah.
But we were in this period, and even then we were in a period of low rates. Rates were under 5% 5 years ago. Typically, people who are coming out for renewal right now are renewing anything from 3.29 to 3.99. So that's what rates looked like in 2017. So we were all going like, this is ridiculous. Like, why are we putting this stress test in place? Well, now we know why. 2021 is a perfect example of why we needed the stress test, because people were getting rates of under 2%, 1.64, 1.54. If you were taking a variable in 2021, you might even have been down at 1.3%.
Wow, is that amazing?
So you can imagine if people were qualifying at 1.3%, and then now that mortgage comes up for renewal and it's sitting in the 5%, that's a big difference. And so the stress test meant that even when people were taking those rates below 1.5%, we were still qualifying them at 5.25%.
Okay.
So they can afford a mortgage at today's rates. It may not feel like they can, but they can. And the interesting thing about the stress test now, the rates we've seen over the last 4 months, is that as rates started ticking up and as they hit that mid 3% range, well, now for a 5-year fix, instead of qualifying you at that 5.25%, we're qualifying you at contract plus 2. Well, rates now today are around 5.09 to 5.34. So on that 5-year fixed rate, we're qualifying you at 7.09 to 7.34.
Now that's a huge difference.
That's a huge difference. Yeah.
And are you finding that is really pushing people to the sidelines? This is, hey, you know what, I just can't do it.
I think so, and that's why you see that big drop on the fixed rate side in borrowing power, 20% on the uninsured and 16% on the insured, because you went up to 7%. You're qualifying up there now as opposed to the 5.25. What was interesting is because it's taken a while for the variable to catch up, because that's based on the Bank of Canada target overnight rate. So during the month of kind of that last half of March, during April, May, and June, you could qualify for more taking a variable rate than you could on the fixed. So we saw a lot of people choosing to take the variable rate, not because they felt like it was the right fit for them, but because it allowed them to qualify for more. And that was because the contract rate was still less than that 5.2, like the contract rate plus 2 was still less than 5.25. So people were getting qualified for the variable at 5.25 and getting qualified for the fixed up at 7. Now, though, with Wednesday's 1% increase from the Bank of Canada, that has changed. And now, if you're qualifying for a mortgage, regardless of whether you're taking fixed or variable, you're qualifying at contract plus 2. But on the variable side, variable rates are still lower than fixed, even with that 1% jump. So you still do qualify for a little bit more with a variable than you do with a fixed.
Let's talk about variable. Let's drill down on that a little bit. I have a variable rate and I'm online and I see the rate the Bank of Canada has raised it 1 point. What impact does that have on a variable rate mortgage? Like today, right now? Any?
Right now? It will, obviously. Now, it depends on if you have a variable rate or an adjustable rate mortgage in terms of what that impact is going to be for you. So if you have a variable rate mortgage, that means that your payment is actually static. So when the rate changes, your payment's not going to change. Your payment's going to stay the same.
Okay.
But the amount of that payment that's going to interest is going to increase because the rate's gone up. And the amount going to principal is going to decrease. And so you're not paying your mortgage off quite as fast as you were before because you're paying more interest. Whereas if you have an adjustable rate mortgage or an ARM, your payment's going to change. And so they're gonna take that new interest rate, your existing amortization, your existing balance, and they're gonna recalculate your payment. For the most part, for most people, it's about I think the math worked out, it's about a $48 increase for every $100,000 of mortgage. Right.
How does someone know when's the right time to switch from variable to fixed?
The answer to that question is never.
So that was easy. The answer is just never.
Do you mean locking in? To lock in, like if you've taken a variable rate and to lock it in?
I do.
Yeah, my answer remains the same. It would be never. I never recommend locking in. Usually as soon as you lock in, you've wiped out all the interest cost savings you had while prime was nice and low. And even with that 1% jump, most variable rates are still sitting below what fixed rates are. Because remember, if you're sitting here and you took a variable last year and you could have gotten, say, 1.99% on a fixed, but instead you opted to take the variable that got you 1.3. Well, now you're sitting here going, okay, my rate's now risen well above that 1.99. I should have taken it. Maybe I should lock in.
Yes.
You're not locking into 1.99. You're not locking into what the fixed rate would have been had you taken it last year. You're locking into whatever the rate is today. And so you end up eliminating any interest cost savings you had while your rate was down at 1.3 and ticking up. Because with the variable, in a rising rate environment like we're in, your savings are sort of front-ended to the beginning of your term, and then the rate moves up and you're paying more and more and more interest, but that doesn't do away with all the savings you had in the beginning, right?
I wonder what percentage of people are taking variable versus fixed?
That's a great question. Again, it's not a stat I have. I mean, I can look at my database to see what percentage, but I would be interested to see if, even if CMHC has that data.
Because a lot of it is it not just peace of mind? I feel better at night. I sleep better at night. I can look 5 years out and think my payments,
Yeah.
$1,800 or whatever.
Yeah.
I just feel better.
Exactly. Oftentimes it comes down to budgeting, right? And if the person is comfortable with knowing that their payment is going to change over the term, or likely could change over the term, or knowing that you might get to the point where you're paying only interest in your payment and not putting anything on principal, if you have that VRM that the payment doesn't change on. So it is a very personal choice, but at the same time, I have a mentor here in the mortgage industry, Dustin Woodhouse, very successful broker. He's now president of Mortgage Architects, one of my sister firms. And he has the saying that is, your life is variable, so your mortgage should be too. And he's right. And I agree with him.
Oh, there you go.
And I mean, I'm using that phrase with my clients all the time. The nice thing about the variable is you're moving with the market. So yes, interest rates are going up, and they're going up for a reason. But guess what? What goes up must come back down. Just like we've seen with real estate cycles, same thing for interest rate cycles. And I do think we're going to see it come down within the next 12 months. My crystal ball is trying to tell me.
I was going to say, that's one of my says, what's your feeling going forward? I mean, it's July between now and is Bank of Canada, who knows this, going to do another one in September, as people are chattering about? You think there's another one up?
I think they're going to do another one up. Yeah. Their goal is 3.5 for the target overnight rate. And that's what, a lot of people get target overnight rate and prime rate confused. But what the Bank of Canada does 8 times a year is they set the target overnight rate. That rate then informs banks and financial institutions what they should set their prime lending rate at. Well, the bank has come out almost basically saying our goal is to get that target overnight rate up to 3.5. Mm-hmm. Wednesday's increase took us to 2.5. The catch there is that listening to most economists, they'll tell you that the space between an overnight rate of 3 and 3.5, that's recession territory. So I think what's going to happen, and most of our Canadian like if you look back in history, most of our recessions were triggered by the target overnight rate going up too high, too fast, too high. But the expectations in the marketplace right now around inflation are just too strong for them to do anything but put the rate up, because it's the only tool they have, and they want to look like they are trying to do something about this inflation. So I do think we're going to see, I think they're going to take it up to 3.5, and then I think we're going to tip into a recession. And then I think they're going to have to bring it down.
Well, it's, everywhere you read, and that's, let's move to the next topic here. And I know we're quickly running out of time. This has been great. Thank you for sharing. I want to talk about mortgage appraisals. Ian and Carol bought a house in July, and they're not getting possession till September 30th. And the bank does an appraisal as part of that application process. You're approved July 10th. And are they going to do a second appraisal at the end of September? And if they do, and it's gone down, now what? Are we stuck?
No, in my career, have never seen a second appraisal requested from a lender. Rare, very rare for that to happen. Usually once that appraisal is done and signed off on, it goes to the lawyers. Credit checks, that's another thing. They'll likely do another credit check, but no, not an appraisal.
Is there a limit to how far that can go out for me writing I buy a house in July, I want to complete in December?
Yeah, when your commitment expires. So most lender commitments are about 90 to 120 days.
Okay.
So if your closing is outside of that 120 days, not only could you possibly be asked for another appraisal, but you need a new letter of employment, you need a new pay stub, everything about all the documents has to be updated. And new credit pull, all of that.
Yeah, okay. That's good stuff. Okay, one more thing before we go. Look at the time's 12. If anybody have any questions, feel free to jump in here. What are the major reasons? There's probably 2 or 3 why a buyer's declined when they're getting a mortgage.
Well, first one is they didn't get a proper pre-qualification done beforehand. And so they did one of those apps, or they worked with, and I'm sorry to say it, but a bank rep who did not vet documents beforehand or properly underwrite. So that's number 1. I would say number 2 is the property. A lot of people don't realize that the property is under just as much scrutiny to be approved as you, the borrower, are. And so I see files fall apart all the time, whether it's something that comes up in a home inspection or an appraisal. So it could be that in the appraisal, the lender sees pictures of the property and the property is not in good repair. If you have MLS pictures that show that the property is not in good repair, the lender could decline it outright. Strata. I have had so many files declined this year for strata files because of.
Talk more about that.
because of remediations, right? So moisture remediations or big projects. Anytime there is a big project being undertaken, usually a lender, especially if there's an engineer involved and we're talking about envelope or moisture issues, they're a no-go until you have a report from the engineer signing off that everything has been fixed and done. And so
even if you have a report saying, this is what we're going to do, this is the money's all here, it's going to be done.
In rare cases, if it's an insured mortgage, because that gives the lender extra protection and the insurer is okay with it, and the work has been identified and the council, the strata council, has voted on the work being done, and they have the funds for it in the contingency fund without depleting the contingency fund completely, then it is possible to get an approval. But you have all these little boxes that have to be checked and line up perfectly.
Certainly, the Nanaimo and other cities have older buildings, 40 plus years, that do need work. There's no doubt about it. Eventually, everything wears out.
Yep.
Just like our knees, same thing, right? Dale, you have a question?
Oh, I was wearing out. That's it.
But that's exactly it, Ian, is those buildings. And I think a lot of them it's a timing thing. You're trying to buy a unit at the time that the building's trying to take care of some stuff that needs to be done. And unless you have just the perfect lineup of events, it may not work for you until they've remediated.
Which is tough for buyers, because the reality is, in strata, and I know we're just about out of time, in strata, the more money you spend, the more peace of mind you're getting, which is great. You can spend $600,000 on a brand new kind of, but I don't have 600. I've got 300, but it needs work. It sort of leaves you in no man's land, doesn't it?
And sometimes you don't know. I mean, I had one that was declined, and it was because the contingency fund only had, well, actually, originally the contingency fund had a negative number in it because they planned certain projects, right? And then it came out, well, no, there's actually about 12K in the contingency fund. And lender was still like, nope, I'm not touching it. Just not enough money in that fund. I had one that got declined on a building, and they couldn't even give us a reason why. They just said, the lender said the insurer won't do it, so we won't do it. So we had to restructure the file, take it to a 30-year amortization so that it couldn't be insured, and submit it to a new lender so that they wouldn't submit it to one of the insurers and get declined on the insurer. And it was a lender we knew already had units in the building. So we were just fingers crossed and we got an approval. But the tiniest little thing can make the difference when it comes to strata.
One more thing on strata. Now you got me thinking strata. What about depreciation reports? Some lenders are thinking, hey, if you don't have a depreciation report, we're not lending. Are you seeing more of that?
Yep, that can be a problem. If the AGM meeting minutes show that a new depreciation report is being ordered and there is an older one, then they may. But if there is no depreciation report whatsoever and no meeting minutes to say that they've talked about it or are planning to get a new one, usually they won't go there.
Yeah, depreciation reports in British Columbia are very, very odd things. Like the government says you either have to do one or you have to vote not to do one.
Yeah.
One of those two things has to happen. It happens at your annual meeting. And even if you do one, you don't have to implement it, which is different than other provinces as well. So they can sometimes go in the drawer over here, which doesn't help anybody. But anyways, there we are. Look at that, 12:30 already, Caroline. We're done.
That flew by. I think we could talk about this. I think Ian, you and I could probably sit here all day.
Dale's already nodding off. We don't want to have that happen, right? So no.
It's typical. It's about 2:00, isn't it?
Anyways, we're going to do these once a month. And if anybody has ideas for topics, let me know. But Caroline, thank you very much.
Yeah, thank you, Ian, for the opportunity. And I look forward to next month.
How do people get a hold of you?
You can reach out to me on Facebook, Caroline Roach, Fitzwilliam Mortgage. You can also find me on Instagram at _Caroline Roach. My email is really nice and easy, mortgages@carolineroach.ca. Reach out to me there. And I've delved into the wonderful world of TikTok, which I'm absolutely obsessed with. So you can find me over there at _Diaries of an Island Girl, where I'm sharing lots of mortgage information as well as ridiculously embarrassing dances.
Well, we're looking forward to seeing those. I'll tell you, it's going to be the highlight of my weekend. There we go. Okay, you have a great day.
All right. Bye.
Bye-bye.